Steve, welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, Steve Hamoan, here to provide you with insights sourced from reputable news outlets to help you stay informed and make well-informed decisions.
Janine, this podcast is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their home ownership dreams. Visit realapproved.ca to learn more about how our experienced team can assist you with your mortgage needs. Let's dive into today's episode.
Steve. So, Janine, today we're diving into a very hot topic, the salary required to buy a home in Toronto right now. According to the latest data from the Toronto Regional Real Estate Board, the market is seeing some shifts.
Janine, yes, Steve, it's an interesting time. Prices are finally starting to erode, especially in the condo sector where transactions have hit a 3-decade low. It's a buyer's market in many ways.
Steve. Exactly. Sales have dropped a staggering 23.1% year over year, and active listings have shot up by 88.8%. This gives buyers more choice and negotiating power.
Janine, the silver lining here is that the annual income needed to buy a home has decreased. It's a trend we're seeing across Canada, but particularly in Toronto, where the median home price dropped from $1,073,900 to $1,068,500 from February to March.
Steve. Yes. And with the Bank of Canada cutting mortgage rates in March, the minimum average household income needed to afford a place fell by $4,190 per year. It's now at $217,010, according to ratehub.ca.
Janine, it's a relief for potential homeowners. Also, in some cities, even where prices are still rising, the required salary for a mortgage has decreased. But Steve, it does make you wonder why anyone would settle in Ontario when places like Regina or Fredericton require less than half the income to buy a home.
Steve. True, Janine. In those areas, the average home price is much lower. But in the Golden Horseshoe region, where home sales have slumped, the combination of lower prices and mortgage rates has improved affordability.
Janine, and securing a lower rate can have a big impact on what you can qualify for. In Toronto, a borrower would save $121 on their monthly mortgage payment compared to if they bought in February.
Steve. That's right. It's a significant saving of $1,452 per year. It just goes to show how much of a difference timing and market conditions can make. Steve. All right, Janine, the next topic on our agenda is the current scenario with variable mortgage rates stalling above fixed rates. This is a bit unusual, isn't it?
Janine, it definitely is, Steve. Usually, variable rates are lower than fixed rates, but right now they're sitting above. The best 5-year fixed rate in Canada is around 3.79%, while the optimum variable rate is about 3.95%. This difference is quite significant for borrowers trying to decide which path to take.
Steve. Indeed, Janine. The Bank of Canada recently paused its rate-cutting spree, which brought variable rates to a standstill for the moment. However, fixed rates have dipped slightly. This creates a unique situation where the traditional advice on variable versus fixed might not apply.
Janine, exactly. And with the bond market's volatility, particularly after the recent tariffs introduced by U.S. President Donald Trump, there's little certainty about where fixed rates will go next. The 5-year Government of Canada bond yields, which influence fixed mortgage rates, have started to climb again after the bank's decision.
Steve. This is why financial advisors are urging borrowers to exercise caution. As Blue Shore financial advisor Karn Toor points out, it's crucial to assess one's risk tolerance. If someone felt uneasy when variable rates were over 6% a few years back, they might want to avoid variable rates now.
Janine, that makes sense. It's all about peace of mind and how much risk a borrower is willing to accept. With the ongoing uncertainty, it's important for borrowers to evaluate their personal comfort levels with potential fluctuations in their mortgage payments.
Steve. And let's not forget the broader economic factors at play. Canada's housing market is already under pressure from macroeconomic uncertainty and buyer affordability concerns. These factors, combined with the U.S. trade tensions, make it a challenging time for both borrowers and developers.
Janine. That's true, Steve. The unpredictability of the U.S. trade policy, particularly with the ongoing tariff disputes, adds another layer of complexity. It's hard to predict what the Bank of Canada will do next, especially with these external pressures.
Steve? Right, and while Scotiabank believes the central bank will hold rates steady, others like Bank of Montreal and National Bank expect further cuts. If variable rates do drop, it could change the landscape for borrowers considering their options.
Janine, it's a wait-and-see situation for sure. But for now, borrowers need to weigh their options carefully, considering both the current rate environment and their personal financial situation. It's a balancing act between potential savings and the comfort of stability.
Steve, Janine, the latest report from Statistics Canada has shed some light on the current state of non-bank mortgage lenders. It's quite an interesting shift we're seeing in the market dynamics, isn't it?
Janine, absolutely, Steve. Non-bank lenders have seen their growth slow significantly compared to the boom years of 2021 and 2022. The rapid rate hikes by the Bank of Canada have really put the brakes on refinancing and new originations. It's a different landscape now.
Steve? That's right. By the end of the fourth quarter of 2024, non-bank lenders held about $405.3 billion in residential mortgages. While that's a 3.5% increase from the previous year, it's clear the momentum has cooled since 2023. The number of outstanding non-bank mortgages edged up to 1.85 million, but the growth was uneven.
Janine? And with balances growing faster than the number of mortgages, the average mortgage size has increased to around $220,000. That's about 13% higher than in late 2020. It seems like borrowers are taking on larger loans, potentially increasing their financial burden.
Steve, another significant trend is the shift towards uninsured mortgages. By the end of 2024, nearly 68% of mortgage dollars held by non-bank lenders were uninsured, up from 60% in 2020. This indicates a growing demand for conventional loans, often from borrowers with larger down payments or those refinancing existing properties.
Janine? Yes, Steve. While the uninsured segment is growing, insured mortgage volumes have been declining. Since 2020, the number of insured loans has dropped by about 10%, with the total dollar amount dipping slightly to $131.9 billion. It's a clear shift in borrower preference.
Steve, and with this shift, we're also seeing a rise in delinquencies, particularly in the uninsured segment. By the end of 2024, $7.8 billion worth of uninsured mortgages were behind on payments, which is a 16% increase from the previous year. The average unpaid balance on these mortgages is now around $260,000.
Janine. That's concerning, Steve. While most non-bank borrowers are keeping up with payments, the rise in delinquencies suggests that some borrowers, particularly those with larger loans, are feeling the strain. In contrast, insured mortgages have remained relatively stable, with only a slight increase in arrears.
Steve Affairs. Overall, about 2.3% of uninsured and 3% of insured non-bank mortgages were in arrears by the end of the year. It's a challenging time for borrowers, especially with the ongoing economic pressures.
Janine. It really is, Steve. It's crucial for borrowers to carefully consider their financial situation and possibly seek advice to navigate these turbulent times. As always, staying informed and proactive can help in managing these challenges.
Steve, Janine, a year has passed since British Columbia's crackdown on short-term rentals. The question on everyone's mind is whether it has actually made housing more affordable. The regulations came into effect last May, and they were meant to restrict short-term rentals to principal residences, aiming to increase the supply of long-term rental units.
Janine, right, Steve? Marv Gandil, a resident of Victoria, described how his building used to feel like a ghost hotel with all the short-term rentals. Since the regulations, he says there's been a noticeable dip in short-term rental activity, and more units are being used for long-term living. But it's not just about the numbers. It's also about the quality of life for residents.
Steve, that's an important point, Janine. The housing minister, Ravi Kahlon, claims victory, pointing to dropping rents and thousands of units being removed from platforms like Airbnb and VRBO. However, experts caution against attributing these changes solely to the new rules. The market is influenced by many factors, including interest rates and economic conditions.
Janine, exactly. While some data suggest rent and condo prices have decreased, it's important to recognize that other factors, like changes in immigration or new units coming to market, might be at play. Andy Yan from Simon Fraser University emphasizes the complexity of these influences, indicating that it's hard to isolate the impact of the short-term rental laws.
Steve, and it seems there's a mixed reaction from the community. While some view the decrease in short-term rentals as a positive shift toward more available housing, others, like Brendan Ogmanson from the BC Real Estate Association, express concerns over the impact on tourism. He notes that hotel prices have risen, reducing accommodation options for visitors.
Janine, true, Steve. Will Gladman from the Vancouver Tenants Union points out that despite some reports of rent decreases, the cost of living remains high. Many tenants are still facing rent increases, and while the short-term rental regulations might help, they're not a panacea for affordability issues.
Steve, it's a balancing act, Janine. The government aims to increase long-term housing supply, but as Premier David Eby mentioned, there's potential for revisiting these rules if rental levels stabilize. Meanwhile, the enforcement of these regulations continues, with significant fines for non-compliance.
Janine, yes, and it's crucial to keep a close eye on how these policies evolve. As Minister Kahlon suggests, other provinces might follow suit, but it's important to ensure that any measures taken genuinely improve affordability without unintended consequences.
Janine, our final topic today is an insightful one for mortgage professionals. We're discussing how brokers can capitalize on the growing alternative lending market. With more borrowers leaning towards alt lenders, it's a sector ripe with potential, isn't it?
Absolutely, Steve. As traditional lending criteria become more stringent, many borrowers find themselves looking for alternatives. This is where brokers can really make a difference by offering tailored solutions that meet these unique needs.
Precisely, Janine. Jennifer Watts from Community Trust has shared some valuable strategies for brokers. She emphasizes the importance of understanding the alt lending landscape and building strong relationships with lenders. It's about knowing the products and how they can fit into a client's financial picture.
That's so true, Steve. Jennifer also highlights the need for brokers to keep educating themselves. The alt lending space is dynamic, with new products and policies emerging regularly. Staying informed can ensure brokers provide the best advice and options for their clients.
And another key point she makes is the importance of communication. Brokers should maintain open lines of dialogue with both clients and lenders. This ensures everyone is on the same page and helps in managing expectations throughout the lending process.
Yes, and let's not forget the human aspect. Many borrowers turning to alt lenders are doing so because of unique circumstances. Brokers who show empathy and understanding can build trust and long-term relationships, which are invaluable in this business.
Exactly, Janine. It's not just about numbers and deals, it's about genuinely helping clients achieve their goals. As the alt lending market grows, brokers who can adapt and offer personalized service will likely see great success.
Indeed, Steve. It's an exciting time for brokers willing to explore this space and expand their expertise. By doing so, they not only benefit their clients, but also enhance their own business prospects.
Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate.
Before you go, a quick reminder. Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your homeownership goals. Catch you next time, and stay informed with the latest industry insights.